Thanks to the LGG, even though it says LGA on there, I'm old-fashioned, I guess, for inviting me to speak about self-financing, which, of course, many of you in the room will know is my favourite subject and has been actually for a very, very long time, probably around about 8 or 9 years now we've been at this. As Peter said before lunch, first suggested by the sector, by both local authorities and Almos, because at the root of this is around fairness to tenants. It's around being more business-like, it's around long-term maintenance, it's around sustainability. But the absolute root of this is what happens to tenants' rent income and where does it get spent. It's about fairness, it's about equity, it's about the best use of resources, and it's about, I think in time, it's about releasing the capacity inherent within the council housing stock base in the 160 authorities that still retain their stock, in order to develop and deliver a long-term, secure financial and business plan after years of literally, metaphorically, practically and politically being second-class citizens. To be a council tenant over the last 20 years has seen your rent, well, over the last few years, has seen your rent go up quite significantly above the level of inflation to join with your housing association colleagues, whereas your home has been in, on average, poorer condition. It has been about spending money with your council and the government dictating how much of that the council gets to keep in order to spend on your home. And by the way, it's not enough. And the bit that is that you pay over to the council that the government doesn't believe that you should keep, it spends on somebody else's services or somebody else's homes. I think we're standing after 8 or 9 years of massive campaigning, lots of detailed work, lots of modelling, lots of talking, lots of discussion and debate. We're standing on the cusp, if you like, of securing a future for council housing and council housing tenants to give some of that fairness, some of that equity and that longer-term security to them in the future. And of course, you know, me personally, but also on behalf of the Chartered Institute of Housing, you know, we would not have been pushing for this for so many years in order for us to stand here now and say it's not what we want to do. Of course, we welcome the way forward that we're going to move. We and you have argued for years for greater flexibilities to run your housing businesses. And we have reached yet another milestone, and we've heard about the milestones from Peter before lunch, and this is a major milestone because we're no longer consulting about this. There's no longer a rapid turnaround timetable to get your responses in to see what might happen in the future. This is about implementing government policy. And it really is a positive move, irrespective of the details, and we're going to talk about some of the details, and there are plenty of wrinkles in this, and we'll come on to those. But the big picture is we're implementing a government policy to free councils up to deliver a long-term future for council housing. And for most of the people in this room whose working lives have played out over the last 20 years, we have not been able to say that until this point. So they asked me to go through the preparing for self-financing, what you need to do through the implementation period, and a few words about preparing for the new world. So if that's okay, that's what I'm going to do. Yeah? No, obviously they've already got off. The chocolate's already sitting very heavy on the stomach. I tell you, if you want one reason why this subsidy system has to go, it's this table. I mean, many of you have seen a version of this table before. These are the estimates of the national subsidy totals in 2010-11 and 2011-12. That's a subsidy surplus, or, as we call it, a tax on tenants of £100 million in 2010-11, with an estimated increase of the tenant tax to £353 million in 2011-12. And because of the way in which the subsidy system works, near 7% rent increases for tenants across England, and I know many of you are struggling to get that through your councils, given the scale of that rent increase and all of the moves towards austerity elsewhere in the public sector and the economy. But less than 2% of those rent increases will actually be diverted back to council tenants in the next financial year. If there is one reason why this system has to go, it's encapsulated in that table. An extra £253 million worth of rent income paid by tenants going down the throat of somebody else's services. And usual charts here, just a bit of technicality, just to keep us alert and bright. We have the red bars there, which is the distribution of net negative through to positive unit subsidy by authority in 2010-11 on the left and 2011-12 on the right. The authority at the far left is represented in the room today in 2010-11, and the authority at the far left of negative subsidy in 2011-12 is also represented in the room today. Both of those are different authorities. The District of South Cambridgeshire, more than £2,000 negative subsidy per tenant in 2010-11, and the, is it district or borough? It's borough of Waverley, isn't it?
Indeed, borough, yeah. Marvellous.
Yes, yes, I don't want to get your name wrong. We all know what Waverley means. More than nearly £2,500 per Waverley tenant going back in negative subsidy in 2011-12. As you can see, 128 authorities paying negative subsidy of £700 million this year, just 50 getting subsidy out of £600 million this year. A massive shift to negativity across the board for next year. 133 negative paying 825 next year, and 41 positive getting 472. Now, we've seen the indicative debt allocation in line with this movement. It's gone up from the prospectus of last year. And there have, and we'll come back to this in a little while, there have been some movements within the overall distribution of the indicative debt settlements, which I think we need to really get to grips with as we prepare the ground for next April. So this is the chart from the settlement, the indicative settlement model, which shows the opening debt of around about £28 billion, and providing we charge rents according to the assumptions in the model, and providing we spend money according to the assumptions within the model, the interplay of the assumptions and the discount factors should mean that all authorities have more money over the longer term, and that we are able to cover, if we choose to, and we don't have to cover down the debt during a very reasonable period, and certainly within 30 years. And I'd just like to congratulate the CLG officials and their advisors on the amount of the detail that has been published. And I know it's for the aficionados, but every single piece of information that you need to know to make an assessment about this proposal is contained in those papers. All of your assumptions around stock movements, around management allowance, around maintenance allowance, around major repairs allowance, around the rent income forecasts, they're all in there. And if it's not you as a housing finance person in the room, certainly your colleagues back at the ranch have everything that they need in order to check the assumptions that are being made. And I guess my advice point number one is just make sure that you check all of those assumptions, because it is not unknown for the government to prepare a draft subsidy determination with errors in it. And because of the movement in debt figures since last March, and because of the factors around the subsidy determination for next year, this is well worth a down in the devil of the detail check against what the proposals actually say. So you ought to be able to compare what the model says about what you raise in rents and what you should spend with what you actually raise in rents and what you actually spend. And you ought to be able to compare what the model says compared to the model that came out last year. And you ought to be able to compare, and this is the one that you must continue to do, I guess, over the next few months, is compare what this model says to staying in the subsidy system. One thing is quite clear, actually, when you compare to the March prospectus from last year, is that some authorities have had a very large increase in their opening debt settlement. In one authority, the debt settlement has gone up more than 30%. In some authorities, that debt settlement has actually gone down. So there has been a distributional shift between last year and this year, and that, I think, merits a real close look. Okay, anybody represented in the room whose debt's gone up by more than 30%? Do you know why? And it's one of those things that really needs to be worked through. So, just a few detailed issues then for the aficionados in the room and others. First thing to say, of course, is Peter, just to reiterate what Peter said before lunch, these aren't the final numbers. So whatever modelling you do, however you play it through in your own authorities, you do need to bear in mind that you need to keep the opening debt sensitive to potential change when the final numbers come out. Now, we've heard that the allowance uplifts have remained, so management and maintenance and major repairs, but in some authorities, as I say, the distribution has changed quite significantly. Do we understand why that is the case? Do we understand why Sheffield City Council's debt has gone up by over 30% and Bristol City Council's is more or less what it was last year? Part of that will be the vagaries of the subsidy system going on a year and playing in, but part of it needs to be understood certainly by the former of those authorities. Secondly, we heard about aids and adaptations being funded, and I'd like to say that that is testament to the power of lobbying and the power of pressure. When the original consultation came out near 2 years ago, rather unsustainable position of having done the research to say there's lots of money needs spending on aids and adaptations, and by the way, we're not going to fund it, and through pressure, through everybody responding to the consultation pretty much and saying we need funding for aids and adaptations, we now move that forward funding. But the assumption that's been made is on a per property basis, is that fair? Do you want to make the case for a different distribution, bearing in mind that if you get more, then other authorities may not? On the rent policy position, convergence is at 2016, and there's some assumption in the model about not being able to reach convergence around a number of properties through the caps and limits, the £2 limit, up until 2016. Absolutely essential for you to compare your actual rent plan, the ones that you have on a per property basis, with that you have got issued through the model. Absolutely essential. I would be willing to bet that most authorities in this room will not be able to achieve convergence in 2016, and the assumptions that have been made in the model will be less than generous than they need to be in terms of that convergence rate. So always worth having a little play around with that as well. We've heard from Peter as well the opportunity to adjust for planned demolitions and other stock costs. Just urge everybody to get some informal communication into CLG officials before the end of March in line with what the implementation document says, so that you do not lose out. In some authorities this is significant, but my experience is that virtually every authority in the country has got some plan to dispose of some property outside of the right to buy, even if it's the odd sheltered housing scheme here and there. Now, we'll come back to right to buy in a little while, and right to buy the receipts and the continued pooling of receipts has received quite a lot of attention from the platform this morning. My view is, or our experience is, that the concession that CLG has made around, we'll continue to see the pooling, but we'll concede a lower opening debt to reflect a reduction in properties. My experience, our experience is that the assumption on right to buy sales volumes is very low. In some authorities, it is as low as it's ever been. We've had right to buy for the last 30 years. Everybody will know what the right to buy sales volumes have been over the last 30 years at their individual authority level. 4 or 5 years ago at the national level, we were doing right to buys up at 40,000 a year. The assumption being made in the model is for 2,500 in the first year. It's the lowest it's ever been, and I think we have to understand the risks of that. And I think CLG government has to understand the risks of that as well. Because it's not true to say that business plans will have sufficient headroom to cope if you've made an assumption of right to buys at 5 a year and then you find that they go up to 70. Because that's what right to buy is about. It doesn't drift between 5 and 6 and 8 and then back to 4 again. It goes from 70 down to 5 and back up to 70 again. So to make an assumption of 5, we just need to understand those risks. And are there any googlies in the detailed preparations on treasury management? I mean, it's a bit technical, but just to alert you to the fact that, you know, your treasury management corporate colleagues may be coming to this agenda a little later than those of you who work in housing and housing finance. That dialogue really should have begun by now about understanding how you're going to fund the cash for the settlement. So the CIH's 3 challenging areas are pretty much the same as everybody else's 3 challenging areas, really. I mean, clearly we would prefer a situation to prevail in which right-to-buy receipts were 100% retained locally. That's our position. It will remain our position. And we want to work towards a situation whereby the risks around future right-to-buy receipt pooling are reduced to a minimum. Secondly, on the operation of the debt cap. Now, we've argued all the way through the self-financing pilot project and since that the best way to deal with this was for the sector to voluntarily adopt a code of practice around covenants, around ratios, similar to the kind of thing that we see in the housing association sector. I've never been one to say we shouldn't have a debt cap or some form of limit on borrowing. That's clearly nonsense. Every housing association in the country has a debt cap negotiated with their funders. And in fact, they're talking about it and updating it every quarter. Yeah, so far more than might be here. But the issue is that they negotiate it with their funders. The issue is it's not imposed by their funders. And it's set in the context of the ability and facilities and capacity within the plan. Now, there may be some options on the debt cap here around perhaps setting it a little higher at the top of the investment curve, or potentially around relaxing the cap where it's desperately needed in terms of hitting decent homes backlogs. But I think the key thing here is that we understand, even if we can't shift this, that we understand that in 4 to 5 years' time, and probably before then, the fact that we will be generating capacity in business plans which is going underutilised because of this artificial constraint on borrowing above the opening level will become so obvious that I believe that the government will have no choice but to think about releasing some of that capacity and relaxing some of the issues around the borrowing cap. Just want to touch on quickly on that googly in the paper around control or looking at borrowing in the remainder of this financial year and next year, and just think about what there might be genuine reasons why people might want to enter into prudential borrowing next year, particularly take advantage perhaps of the feed-in tariffs before they're reformed, perhaps around other investment in retrofit and green agendas. So certainly don't want to see any kind of artificial block on prudential borrowing next year when it's clearly to the benefit of tenants and, crucially, to the long-term sustainability of the business plan. Now, I'm not going to say anything more about reopening the settlement. Our position is what's been said this morning. I think the longer it goes on, the less likely it is to be reopened. That's a personal view of mine, but clearly we need those commitments up front. And the two areas that have been mentioned in the document about changing rent policy and changing the quality of home standard, I think if we can get commitments around that, that is pretty much where we're going to be able to get to. And a few questions there. So where are the issues in this? Where are the risks? And what are the options for addressing the risks? I think everybody needs to be thinking about how they move forward around their risk management. I'll come back to that in a little while, but I think one of the big issues is this. For all authorities, this will mean more resources under more local control over the longer term. Some are left better off in revenue terms quickly. That's just the vagaries of the ending of a very complex national system. But for many, the real power of self-financing will develop over the medium to long term. But for some, and we've got to be really clear about this and really honest about it, for some, the pressures in the early years might be too great to allow a sustainable plan to be developed. If you are with a big backlog on decent homes, which may be underfunded from the announcement that is about to be made, if you are up against your debt cap on day one, and as you are now going to have to continue to pool your right to buy receipts, or 75%, there may literally, as well as metaphorically, be some councils who, without any meaningful process for stock transfer to be delivered from the first day of self-financing, may literally, as well as metaphorically, have no place to turn in funding what needs to be funded in the early years of the plan. And I'm not sure that on a technical level that's actually acceptable. Because all authorities should start the new system without the need to struggle to meet backlogs that have built up for decades. Let's be clear about this. This has been a national system since 1919. For 92 years, the funding of council housing has been the responsibility of central government, not local government. So any backlogs that are with us up until now, in my view, technically, this isn't a political statement, it's a financial statement, are the responsibility of central government to address and not local government. So we really need to have and work closely with government to make sure that there are no authorities where they will not be able to meet the basic needs of their tenants in the first few years and therefore the long-term plan. And I look forward to working with officials and ALMOs and local authorities up and down the country to solve this problem, because in some authorities, let's make no mistake about it, this is a problem. So just a few words then before I tie up around developing and what you should be doing. I mean, clearly, you should be thinking about developing plans for taking out the money and make sure that they don't come along next 31st of March and want 150 million quid and you haven't got it to pay. David, 240 million pounds you've got to find. Do you know where you're getting it from yet?
Whip round later.
There are opportunities to save money and to maximise value in the settlement transaction, perhaps bringing back money that you've got on deposit, perhaps borrowing now or borrowing in advance of whatever. And that all needs to be thought through. You need to update your initial HRA 30-year model. I put complete in. I hope there are no authorities that haven't got one. But, it's possible that they haven't, so update your plan. And assess the impact of the new figures, given your 11-12 budget base and known capital plans. And ideally, you really need to be doing that this side of Easter, so that you've got an opportunity to get into CLG any issues that particularly affect your area. You need to run scenarios and identify these key factors. They were going to be different in different places. We've identified some of those there. Repairs backlog, starting position on debt, or the position on rent. We do need to assess the impact on the general fund and alert the department to any unintended consequences, because I understand that they may be open to proposals to mitigate adverse general fund effects as appropriate. We need to develop a new approach to risk management fit for the new world, where we've got a shift in the balance of risks from the risk of being in a national system and being linked to everybody else, which is political and volatile, to an interest rate and inflation risk, a more business-like set of risks. And of course, as we've heard already, we need to think about planning to establish an HRA business plan for April 2012. And you must talk to your tenants and stakeholders in advance of April 2012. You must talk to the rest of the council, and ideally, you will want to have some kind of updated business plan statement in place for next April, even if you don't necessarily change your plans immediately and they evolve over the first few years. You certainly need to be going through that process of dialogue and discussion about how you prioritise in the new world. At the moment, they tell you how to spend your rent pound. They tell you what to spend on management, what to spend on maintenance, what to spend on major repairs, and what to spend on your debt. All of that is gone in the future. You get to agree with your tenants what to spend your rent pound on from the first day. And finally, when HRA business planning was introduced, there was a 184-page guidance on how to do it, but it's always been, I would say, a bit of a plaything for people like me and the HRA accountants in the room. The only thing you could definitely say about an HRA business plan was it'd be wrong, because the subsidy system was so unpredictable and unforecastable. Now we've got an extra £28 billion worth of unsubsidised debt coming onto authorities' books. The risks are important, but they are containable. And as Robert mentioned earlier on, they are still much less per unit debt figures than in the housing association sector. The rewards are potentially significant. This is the time now for business planning to become real. This is the time now for you to begin a dialogue about how you spend your money. And I just want to finish off really with just a thought about how we might think about resource allocation and business planning moving forward. When I get paid, the very first thing I do the day after I get paid is pay the mortgage, just so that the rest of the family can't get hold of my income before the mortgage gets paid. So the first call on our rent income must be to cover existing debt. The second call must be to set aside enough money for the long-term maintenance of the stock, such that properties are maintained, such that they continue to raise rent income, so that you can continue to cover your debt. So we've got quite a lot of this, which, and if you'll excuse the expression, I put my HRA hat on, the general fund has got no interest and no call on, because we need to get the debt covered and we need to maintain the assets. And the third call then is around service delivery and other priorities. And once we've covered the debt, and once we've secured the long-term future of the stock, and once we've sorted out our service delivery and improvement priorities, then, over time, we can start to talk about developing and growing this sector again. Thank you very much.